Thank you so much for giving us the opportunity to present at this conference. Today I'm presenting our paper on dealer networks and the cost of immediacy. This is joint work with Jens Stig Nielsen from Copenhagen Business School and with Obaidur Rehman from BI Norwegian Business School. Obaidur is a PhD student here who will be on the market in January. In this paper, we study over-the-counter markets in which dealers intermediate trades between investors, but dealers also trade with each other. And we focus on an important feature of OTC markets, namely the interdealer network. Most OTC markets have a core-periphery network structure. And this figure is from the US corporate bond market, where each circle denotes a dealer. The size of the circle reflects how central the dealer is in the network, and each line denotes a trading relationship. And core dealers are highly interconnected, and they account for most of the trading activity relative to the peripheral dealers who are less connected. An important question is how transaction costs depend on dealer network position. And there's conflicting empirical evidence on the centrality spread, which measures the difference between trading with a core dealer compared to trading with a peripheral dealer in terms of transaction costs. Now, on the one hand, there is evidence of a centrality premium in the markets for foreign exchange, municipal bonds, and in the corporate bond market. But on the other hand, there is evidence of a centrality discount in markets for securitizations and in the corporate bond market. So not only do we have conflicting empirical evidence across various OTC markets, we also have conflicting empirical evidence within the corporate bond market. Now, identifying how network position affects transaction costs is important for understanding price formation and how liquidity is provided in OTC markets. Now, there are various economic channels that can rationalize either the existence of a centrality premium or a centrality discount, but the key challenge empirically is to disentangle these channels from each other. So what we do in this paper is that we isolate a particular channel, the inventory management channel, which describes that dealers with wider trading networks, that is the core dealers, they're better able to manage inventory risk because they have more potential trading partners. So the research question we ask is how the cost of immediacy depend on dealer network position. Now, I emphasize immediacy because in OTC markets, dealers generally have two options when they're contacted by an investor who wants to sell a security. On the one hand, the dealer can execute the order immediately by buying the security from the investor and putting it on the dealer's inventory. The dealer's supplying immediacy. On the other hand, the dealer can ask the seller to wait until the dealer has located a counterparty who's willing to take the opposite side of the transaction. So to identify the inventory management channel, we clearly have to use trades in which dealers are actively using their inventories. And to do so, we exploit a unique trading environment in the US corporate bond market by looking at corporate bond index exclusions. So in corporate bond markets, index trackers compete on having a low tracking error. This implies that whenever a bond gets excluded from the index, then these index trackers have a strong desire to sell the bond on the rebalancing date when this bond is excluded from the index in order to minimize the tracking error. So index trackers are demanding immediacy, and dealers are using their inventories to supply this immediacy to the investors. Now, looking at trades around these index exclusions, we can isolate the cost of using the dealer's inventory. So by using trades around index exclusions, we document two main findings. We find a customer dealer centrality discount, meaning that transaction costs are lower at the core compared to the periphery when customers are trading with dealers. But when dealers are trading with each other in the interdealer market, we find an interdealer centrality premium. We attribute both of these two findings to the inventory management channel. So we show that core dealers provide more immediacy, but also unwind their inventories faster. Now, the fact that core dealers have a comparative advantage in managing inventory risk predicts that they can charge lower transaction costs to customers, hence a centrality discount consistent with our findings in the customer dealer market. But at the same time, a core dealer also derives market power from having a central network position. So when a core dealer trades with a peripheral dealer in the interdealer market, the core dealer can dominate that trading relationship and extract more surplus from the peripheral dealer. So this market power channel predicts that transaction costs should increase with centrality, or in other words, a centrality premium, consistent with our findings in the interdealer market. So now that I've explained our main findings, let me give you some more details on how we identify the demand and supply of immediacy around exclusions. Now the figure on the left here, I plot the average trading volume in event time, 50 trading days before and 50 trading days after the exclusion date, which is event day 0. So this figure shows that there is a clear dramatic spike on the exclusion date itself and in the 2 to 3 days leading immediately up to exclusion. So this is the index trackers that are selling their bonds. They are demanding immediacy from the dealers. Now looking at this from the dealer's point of view, we move to the right-hand plot here, where I show the average cumulative inventory across dealers. Also in event time, and event day 0 is the exclusion date. So you can see that there's very little inventory build up prior to the exclusion date. And then when these index trackers are demanding immediacy, this is where we see a spike in dealer inventories. So dealers are using their inventories to supply this immediacy to the index trackers. After the exclusion date, dealers are then unwinding their inventories, as you can see on the right side of the plot here. And the fact that these index exclusions is a liquidity event is well known in the corporate bond market. This was most recently exemplified during the COVID crisis of last year, where in March 2020, several index providers decided to postpone index rebalancing by a month in order to avoid having forced sales during a period of already acute market distress. So as I mentioned before, we use these traits around exclusions to identify the inventory management channel, which is formalized in a set of models by Wang and Wei, Uslo, and Kjaer and co-authors. And alternative explanations of the centrality spread include adverse selection. So Babos and Condra have a model based on asymmetric information, where they show that core dealers charge lower markups to investors because these core dealers observe more order flow and can therefore more quickly learn the true value of the fundamental value of the security traded. But adverse selection clearly cannot explain our findings because index exclusions are entirely information-free events. An alternative explanation also includes customer clienteles in the search-based models. So DNSHOF have a model in which they consider a trade-off where investors trade off execution cost against execution speed. So some investors have a strong preference for fast execution. They trade with core dealers that supply this speed, but the core dealers do so at a higher cost. So their model predicts a centrality premium. Using a similar model, Holyfield and co-authors instead assume that these customers with a strong preference for execution speed are also the more sophisticated customers, in the sense that these customers have more valuable outside options when they bargain with dealers over the transaction price. So this allows the sophisticated customers to negotiate better terms with the dealers and therefore trade at lower transaction cost. So this would tend to predict a centrality discount. The customer clienteles is also unlikely to explain our findings. Firstly, because index trackers require fast execution, they demand immediacy. And secondly, these index trackers have weak outside options when they trade with dealers because they simply have to sell those bonds that exit the index in order to minimize their tracking error risk. In addition, we also do a number of robustness checks to rule out these alternative explanations that I'll return to towards the end of the presentation. First, I want to give you some more details on how index tracking works in the corporate bond market. So these index trackers are not holding every single bond in the index. Instead, they're sampling the index by borrowing some of the bonds that are already in the index. The index we consider is the Bloomberg Barclays US Corporate Bond Index, where index requirements include that a bond's issuance size must exceed a certain threshold, a bond's time to maturity must exceed 1 year, and that the bond must have an investment grade rating. And exclusions from this index always happens on the last trading day of the month at 3 p.m. Eastern Time. The type of exclusions we consider is when a bond's time to maturity drops below 1 year during the month, then by the end of that month, it gets excluded from the index. And similarly, when a bond is downgraded from investment grade to speculative grade during the month, then by the end of that month, it gets excluded from the index. And importantly, these rules for exclusions are known to all market participants, and they're entirely mechanical. So this makes index exclusions information-free events. The data we use is transaction-based data from Academic Trace. And this data set contains anonymized dealer identifiers. This is what allows us to map out the network structure and also to track dealer inventories through time. Our data is from 2002 until 2013, and we get bond characteristics from merchant FISD. You can see that we have a fairly large number of index exclusions, of which most of these bonds are traded in trace. And we see that for most of them, we have a dealer buying from an index tracker at exclusion. And we see for most of them, dealers also selling bonds after exclusion. We then use a sample of all non-convertible corporate bonds that are not Rule 144A issues to characterize the network structure. So the centrality measure we use is the eigenvector centrality score, which takes a value between 0 and 1, where 1 corresponds to the most central dealer. We compute this centrality measure at the end of each month for each dealer based on all interdealer transactions within that month. And this centrality score reflects both the number of trading partners, but also the relative importance of the trading partners. And we find when we look at these dealers that offer immediacy to the index trackers at exclusion, that these dealers on average have a much higher centrality score than the average dealer in the bond market. What this means is that it's mostly the core dealers that provide immediacy to the selling index trackers. We then use these centrality scores to divide dealers into two groups, core and peripheral dealers, and then we track their inventories through time. So in the top panel here, I show you the cumulative average dealer inventory in event time, where again, event day 0 is the exclusion date. So here we can see again, there's very little inventory buildup across or before the exclusion date, and then we have the spike on the exclusion date itself. But notice here that the spike is much more pronounced for core dealers than it is for peripheral dealers. So it means that core dealers are providing more immediacy than the peripheral dealers do by an order of magnitude of 2 to 3 times. When we look at downgrade exclusions in the lower panel here, we find the same pattern. Core dealers are providing much more immediacy than the peripheral dealers are doing. You may notice here that there is a bit of inventory buildup prior to exclusion, and this is because the downgrade date is before the exclusion date. There are some investors, such as pension funds, that have to sell out when a bond is downgraded from investment grade to speculative grade. But in both cases here, we have that after exclusion, dealers are unwinding their inventories. We then want to analyze the speed by which dealers are unwinding their inventories post-exclusion. And to do so, we exploit a regression specification. So for each dealer in each month, we estimate the inventory adjustment speed beta. We estimate this beta by taking the change in inventory for a given dealer between event day T-1 and event day T, and then regress this change in inventory onto the difference between the lagged inventory and this I star, which is the dealer's target level of inventory. So a more negative value of beta here implies that the dealer is adjusting his inventory towards the target at a faster rate. We then take these estimated betas and regress them on centrality, and then we find a negative coefficient estimate. So this means that core dealers are unwinding their inventories faster compared to peripheral dealers after exclusion. So now that I've shown you that core dealers provide more immediacy than peripheral dealers, and core dealers unwind their inventories faster than peripheral dealers, core dealers have a comparative advantage in managing inventory risk. So now let's look at the cost of using the dealer's inventory around exclusions. So to do so, we do a separate analysis for customer dealer trades and one for the interdealer market. For the customer dealer trades, we compute a dealer bond specific volume weighted price when a dealer is buying from index trackers over the 2 event days, leading immediately up to the exclusion date, which is day 0. Then we also compute volume weighted prices on each trading day following the exclusion event. So from trading day 1 to trading day 30. For interdealer trades, we compute bond-specific volume-weighted prices for each dealer pair. We do this over the entire event window from 2 days before the exclusion to 30 days after. This period roughly corresponds to the time it takes for dealers to unwind a large fraction of their inventory buildup. Importantly, in all of our regressions, we have interacted bond times day fixed effects, such that we compare transaction prices for the same bond on the same day. So the regression we run is that we take the price for dealer I, bond J on day T, and regress it on the dealer's centrality score in the same month, and then we control for the amount of immediacy provided. If we look first at maturity exclusions, we find a positive coefficient estimate when dealers are buying from customers, and we find a negative coefficient estimate when dealers are selling to customers. So the fact that the core dealer buys at a higher price and sells at a lower price implies a lower bid-ask spread. So core dealers are charging lower transaction costs to customers compared to peripheral dealers. Now we find the same for downgrade exclusions. Here you may notice that the coefficient estimate is insignificant, but this is due to the fact that prices of downgraded bonds at exclusion during the financial crisis were extremely volatile. So by excluding the financial crisis period, this coefficient estimate becomes significant as well. For comparison, we also include our regression where we run it in the entire corporate bond market. This is what we call the all corporate bond sample. So here we also find a positive estimate on centrality when a dealer is buying and a negative estimate when the dealer is selling. So for index exclusions, we can uniquely identify the inventory management channel, whereas we cannot do that with certainty in the entire corporate bond market because there all channels may be active at the same time. But we do find exactly the same results in the entire corporate bond market as we do around these index exclusions. Now, the second thing we do is that we also look at trades in the interdealer market. So here we take the interdealer price, regress it on the buyer centrality, on the seller centrality, and control for the amount of trades between the two pairs. And again, we include bond times day fixed effects. So now we find a negative estimate on the buyer centrality and a positive estimate on seller centrality. So in the interdealer market, core dealers are buying at lower prices and selling at higher prices, thus implying a higher bid-ask spread. So in the interdealer market, we have a centrality premium. We have exactly the same findings for downgrade exclusions and also in the entire corporate bond market. So these two findings are consistent with the inventory management channel because core dealers have a comparative advantage in managing inventory risk. This allows them to charge lower transaction costs to their customers. But when these dealers are trading with each other in the interdealer market, because core dealers derive market power from their central position, they can extract more surplus when they trade with peripheral dealers, which is consistent with the interdealer centrality premium. So these two results are for trades where dealers are actively using their inventories. But because of our data with anonymized dealer identifiers, we can also identify trades where dealers are not using their inventories altogether. So we look at these prearranged trades because they contain zero inventory risk. We identify a prearranged trade as when the same dealer buys and sells the same bond with the same volume within 60 seconds from each other. When we then look at the prearranged volume out of the dealer's total volume, we find that peripheral dealers are prearranging a lot more trades than the core dealers are doing. So this means that peripheral dealers are more averse to inventory risk, or conversely, that core dealers are more willing to use their inventories to supply this immediacy around exclusion. Now, we also differentiate between different types of prearranged transactions. In particular, we look at the type of counterparties the prearranging dealer has. So the first type of prearranged trade is what we call a CDC trade. This is when a customer sells to a peripheral dealer, to a prearranging dealer, who then sells to another customer. So here we have a customer on both sides of the transaction, and the dealer is not exploiting his interdealer network position. For all the other types of prearranged trades, the dealer relies on the network. So for example, for a CDD prearranged transaction, where a customer sells to the prearranging dealer, who then sells to another dealer through the interdealer market. Or a DDC, where it's the dealer selling to the prearranging dealer, who then ultimately sells to a customer, or an entire interdealer transaction. Importantly, all of these prearranging dealers in these examples here take zero inventory risk because they maximum own the bond for 60 seconds. So what we do next is that we then study how the markup earned by these prearranging dealers depend on their centrality score. So we take the dealer sell price, that's the price he gets when he sells to the customer. Subtract the dealer buy price when he buys from the seller, and then compare that to the mid price. So that gives us the markup. We then take these markups for dealer I, bond J, and day T, and regress it on the dealer centrality score and control for the trade size, again with bond times day fixed effects. So now we find that for these CDC prearranged trades, we find a centrality spread, which is not significantly different from zero. The dealer is not taking any inventory risk, and there is no centrality spread. But when dealers are instead using their network for at least one leg of the prearranged trade, we find a centrality discount. So this finding is consistent with our previous evidence of a centrality premium in the interdealer market, because if you as a customer ask a core dealer to pre-arrange your trade, the core dealer can trade on better terms in the interdealer market. And the fact that we find the centrality discount here suggests that you as a customer get to share part of that benefit. As I mentioned before, we also do a number of robustness checks to rule out these alternative explanations of the centrality spread. So we call the adverse selection channel is the core dealers observe more order flow. This allows them to more accurately detect the true value of the underlying security. So in all of our regressions, we have these interacted bond and day fixed effects. So we already control for all bond and issuer time varying information, but dealers still may have a different capacity to learn new information. So the way we try to come up with a proxy for this capacity to learn new information is to make a proxy based on the dealer level fraction of total order flow. So when we include this proxy in our regressions, we basically find that our main coefficient estimate remains basically unchanged. In addition, we also use two proxies to accommodate the potential customer clientele story. So here we call that customers with stronger outside options trade with core dealers, and they can do so at lower transaction costs, so a centrality discount. So here we use an inverse proxy for customer bargaining power, utilizing that the bargaining power is split between the dealer and the customer. So we control for the dealer market share as an inverse proxy of customer bargaining power. In addition, we also make a proxy based on the dealer level fraction of block trades, where the underlying assumption is that a block trade comes from a more sophisticated investor. But again, using both of these proxies, we basically find that our main result remains exactly the same as before. The last robustness exercise we do is to exploit that we can use trade size as a proxy for the level of sophistication for the customer. So generally, we think of large orders coming from more sophisticated clients. So if the customer clientele channel is explaining our centrality discount, then we would expect core dealers to on average trade in bigger sizes. We actually find exactly the opposite in the data. So for institutional size trades, we find that core dealers on average actually trade in smaller sizes compared to the peripheral dealers. Despite the fact that core dealers do provide more immediacy in aggregate, the average trade size decreases with centrality, both for maturity exclusions and also in the or corporate bond sample. So I have 2 minutes left, so let me move to the conclusion. So we use these trades around index exclusions to isolate the effect of the inventory management channel. We document the customer dealer centrality discount and an interdealer centrality premium. Both of these findings are consistent with the inventory management channel, where we show that core dealers are providing more immediacy, also unwind their inventories faster after exclusion. And this comparative advantage in managing inventory risk allows a core dealer to charge lower transaction costs to a customer. But when a core dealer trades in the interdealer market, he gets market power from his central network position, and that is what allows him to trade in better terms in the interdealer market, which corresponds to core dealers charging higher transaction costs to their counterparties in the interdealer market. So I'm a bit early on time, but that just gives more time for the discussion. Thank you so much. I'm looking forward to the comments and the feedback.